Hi, everybody. Thanks for joining. Before we get started, I want to ask everybody to hit subscribe to my channel to make sure you keep up with all of my latest investing and personal finance content. And please check out the link you see on your screen right now for a special offer from our sponsor, The Motley Fool, where you can get the 10 best stocks to buy right now. All right. So, a lot of people, when I tell them that Berkshire Hathaway is one of my largest stock investments, they say things like Warren Buffett's lost his touch. Do you really think it's still a great investment? Do you think you just might as well just buy an S&P index fund? Do you still think Berkshire Hathaway could beat the market over time? And the short answer to that last question is yes, I do. And I'll tell you why. So, just kind of a quick overview of what Berkshire Hathaway is today. So, Berkshire has over 60 subsidiary businesses, including a lot of household names. Geico is a Berkshire Hathaway company. Pampered Chef, Duracell, Dairy Queen, Clayton Homes, Fruit of the Loom, Brooks Running Shoes, See's Candies, all are Berkshire subsidiaries. They have a massive railroad. BNSF is one of the largest railroads in the world. They have a big utility business, a big real estate business. In all, there are over 60 different companies that call Berkshire its parent. There's also a stock portfolio worth well over $300 billion that Buffett and his team have accumulated over the years, including large stakes in companies like Apple, Bank of America, Chevron, American Express, Coca-Cola. I could go on. There's about 4 dozen stocks all told in that portfolio. So over the past, Berkshire has been one of the biggest wins in the stock market, hands down, period, the end, since Warren Buffett took over. Buffett took over in mid 1964, and from 1965 through the end of 2021, Berkshire Hathaway produced over 20% annualized returns for its investors. Now, that's a phenomenal record of performance to keep over that long period of time. In all, someone who invested in Berkshire on the day Buffett took over would have gotten over 3.6 million% total returns. That's a massive, massive amount. That's not going to happen again. If Berkshire keeps growing at that 20% annualized rate, after another 20 years, it would be a $24 trillion business. After 30 years, it would be a $243 trillion business. The numbers are just getting too big for it to make sense anymore. It's not going to, Buffett himself has even said Berkshire of the future is not going to match the performance of the past. The numbers are just too big now. However, I do think this is a stock that can handily outpace the market over time. It might not double the market's performance every year, but it can exceed the market's performance. Specifically, I give Berkshire three big advantages over investing in just an S&P 500 index fund. So, number one, unlike most of the companies in the S&P, Berkshire has a lot of optionality when it comes to its cash flow. Because it owns over 60 subsidiary businesses that generate money, as well as a stock portfolio that generates billions of dollars in dividend income every year, it can take all of that money and direct it wherever it sees the best opportunities. Most companies don't have those types of options. They have one business. If they could either reinvest in their business, they could pay a dividend, they can buy back shares. But Berkshire has a bunch of different places and can be very opportunistic with its cash. And speaking of cash, advantage number two is they have a ton of financial flexibility. Buffett always keeps a large stockpile of cash on the sidelines. Berkshire has over $100 billion worth of cash on its balance sheet as I'm talking. This gives it tremendous flexibility to take advantage of bargains during the tough times. This type of financial flexibility is what allowed Berkshire to buy Bank of America at a fire sale valuation after the financial crisis. Other investments like American Express was a kind of distressed investment for Berkshire. It has the money to be a provider of capital when companies need it the most. Big advantage there. Number three, it is designed to outperform the market in bad times. Investors don't really understand why that's so important as much as they should. The S&P 500 has had 11 negative years since Warren Buffett took over. It's probably about to be 12 this year. And Berkshire has outperformed the S&P in all but two of them. So think of it this way. If your stock drops by 50%, you need 100% return. You need it to double just to get back to even. So being able to weather the downturns without dipping to where you need a massive recovery to get to new highs can be a big driver of long-term performance. So if the S&P delivers, say, 10% annualized returns over the next 30 years, my goal with Berkshire is 11 or 12. I think it will outperform the market over time, not by the margins that it has previously. And on a separate note, I'm really not worried about Warren Buffett stepping down or no longer being in the leadership role. Berkshire has an excellent succession plan. Their management team is fantastic. There's two vice chairmen who are going to take over when Buffett's gone. There's two investment managers that are going to run the stock portfolio. Buffett's in his 90s, so he's not going to be around forever. But the transition is set up to be a very smooth one, and all the parts are in place to continue the cycle of value creation for decades to come. Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by the Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.